Very good evening to everyone. Am I audible to the audience? Yeah.
Yes.
Perfect. Thank you. Thank you so much. It's just to make sure we don't have any technology glitch. The acceptance for this meeting invite is significant. So what we'll do is we'll give it a polite minute and let you stare at the lovely Suyesh. Thank you so much, everybody, for joining this very first webinar that Meta Accountants is conducting. The person you've been listening to alongside myself are Aditya and Suyesh, the founder. He's the main pillar of Meta Accountants. And along with him, Aditya Ghiya is heading the Meta Accountants India arm. The main objective for today's conversation is what we believe is the biggest UK tax change in generations. And what we intend to do is educate everybody, follow our philosophy at Meta Accountants, which is to share and care. I mean, a lot of people are still trying to make sense out of what is happening. And that's where we believe that this webinar will be very beneficial for yourself. So, the very first point that we had in mind is what has changed on April 2025?
That's the question of the hour, Anis. Thanks. A lot of my family members, close friends have joined this webinar today, including a lot of our existing clients. I wanted to share all these information with all of you because I think it is so important that everybody must be aware about what has happened last year, or rather this current financial year. With my experience of doing so many tax planning with hundreds of clients, people were just not aware about basics. They don't know that overseas income is taxed. There are some reliefs that you can claim, basic reliefs. So how do I let people know? I continuously share knowledge on WhatsApp groups and Facebook groups. So this is just upgraded version this time now. So that's the reason why we are doing this webinar, just to make people aware about what really has changed in the tax space, especially for non-domicile individuals or people who have overseas income. So from this year onwards, which is 25-26 financial year, it has been a monumental change in my opinion. The domicile basis of taxation has been abolished alongside the remittance basis of taxation. And that is huge in my opinion. It doesn't really matter what is your domicile now. As long as you have lived in the UK for over 4 years, you will have to pay tax on every pound you earn overseas. Whether you bring it into the UK or you don't bring it, it doesn't really matter. You need to really plan well on what are you doing about your overseas income. I mean, I do so many tax planning, and obviously there are a lot of people who are just not aware about basics. So just think about it.
You mentioned about the remittance basis switching off and the FIG regime. These are the terms. We've spoken about this quite a few times. It makes sense, but it doesn't make sense. So, in layman's term, what does that mean to my money, to my pocket? For example, let's say I've got properties abroad and I've got rental income coming in. So, what
if you have overseas income and you decide not to declare? That's your question, right?
Exactly.
Yeah. So if you decide not to declare, then that's a big risk that you're taking. First of all, because of the common reporting standards in place between 100 plus, I think it's way more than 100 countries now that they are reporting to each other. And as a result, you see thousands of people are now getting worldwide disclosure letters in UK. Now, the Indian residents in India are getting letters for overseas income. So this is a real risk, and that's exactly the awareness that we want to talk about. And we discussed about domicile being abolished and remittance being abolished, which basically, in simple terms, means you do not have the option anymore to say that you have not remitted the money into the UK, so you don't have to pay tax. Just understand that as the very basic of it, okay? You just have to pay tax on every income that you earn overseas. The new rule is about new FIG regime. So what that means is there is a new regime in place, which is called foreign income and gains regime. What that means and what it says is exactly that now you have to pay tax irrespective of bringing or not bringing, and it's on residence basis. As long as you are resident in the UK, the first 4 years is tax free. So that's the most amazing part about the FIG regime. The first 4 years, and this is only amazing for the newcomers, okay? So if you are newcomers and you have come into the UK recently from this year for 25-26 tax year onwards, the first 4 years is a sweet spot for you. And again, this is a gold mine of tax planning. So you need to really get your act together, make sure that you utilize the first 4 years in the best way possible, because you will not pay any tax. And the most amazing thing about FIG regime is, Anis, that in this one, you don't declare overseas income, yet you're free to bring it. So that's a massive difference from remittance basis. Because in that regime, you had to claim remittance basis, then you're not allowed to bring that money into the UK. But in FIG regime, that's not the case. You don't declare and you're free to bring all the money. So it's a huge tax planning option for everybody who has just arrived in the UK. And one giveaway that one of the biggest reason I'm doing this webinar, because I thought these guys are going to miss out big time. So anybody who has come into the UK from in 22 or 23 tax year, this last 2 weeks, these are the last 2 weeks for you, because this is your fourth year in FIG regime. So after from 6th of April 26, you will pay tax on every penny that you earn overseas or any gain that you make overseas. So make sure you definitely speak to someone. Of course, you can get in touch with us, or if you have a tax advisor, please go to them and make sure you plan your taxes very well. If you have to dispose of, please do, so that you can have that money and remit without paying any tax. Because from 2 weeks or 3 weeks onwards, you will have to pay tax on everything. Yeah,
Yes,
I think
yeah.
that's the, again, as I said, we can go on, and
Yeah.
this is the most important point on the FIG regime and the abolishment of domicile and residence. And yeah.
Oh, brilliant. Thank you. So that's, wow, remittance basis changes and FIG regime. I think these are the kind of key takeaways I would say everybody should kind of read about it and kind of see if they are actually impacted by them. I believe they will be impacted actually. So the next jargon that gets thrown at people is TRF, Transitional Repatriation Facility. Again, from my point of view, the question remains the same, right? What exactly does this mean for anybody? If they do nothing, what happens, and what are these lovely terminologies that I'm seeing against TRF? So over to you, Suyesh.
Yeah, TRF is, of course, just the extension of what we discussed. So I think TRF is an amazing, I would call it like a tax relief, to be honest, because what it means is it's just exactly the name says. We had an old regime and then we have a new tax regime. So obviously, when you were filing tax returns via old regime, and I think most of you that has joined us this evening would have been here for a long period of time. So you might have in your space, in your previous tax return filings, must have claimed remittance basis, of course. So what happened? Because now remittance basis is all of a sudden gone. So what would have happened is you would have paid 45% tax on it in the current year. Obviously, there could be reliefs and all that. Let's not go into that detailed topic. But just simply understanding that if you were to remit, you pay 45%. That's £4,500 in tax. But actually, what would happen now is, because there is a new regime, government had introduced this transitional repatriation facility. So what they are saying is that if you have claimed remittance basis previously and you've got a lot of money stashed away overseas and you want to now bring it, they are giving you a reduced rate of 12%. So this is a great, again, planning option. And reason why I'm doing this webinar, because I wanted to at least make you guys aware that these things are there. Please make sure you are utilizing it. I'm pretty sure not a lot of people would want to bring money from India to UK because of, or from anywhere else for that matter, because the exchange rates are not right, or you just don't want to. But there could be one person out of 400 plus people that are attending or they have registered with us. Even if one person does this and they save from 45 to 12, my purpose is solved. So that's the point. So you need to really, really try and understand that this is a good tax planning option that you have if you have previously claimed remittance basis. So look into that. What I would like to also add here is this is available for few years actually. So it's available for 25, 26, it's available for 26, 27, and it's also available for 27, 28. But in 27, 28, it goes to 15%, and then it's a hard stop. And then you pay marginal rate. So you really need to definitely plan it very well, and obviously do your planning in the best way possible. If you have had a lot of money sitting in USA or Australia or wherever for that matter, and you want to bring that money because there are emergencies
Okay.
everybody has, so think about it. Yeah.
Really, really useful. And I'm the mention about a 2028 deadline, isn't it? I think a lot of action for people who are listening to you then.
Well, 28 deadline is the last date of the year. To be honest, the deadline could be slightly even later, because you need to file self-assessment by end of 31st March. So you could still
Okay.
elect later on, So 31st Jan, sorry, not March. The 31st March is in my head because of the tax planning I'm doing so many.
Okay.
Anyway,
So I think
yeah.
the next very, I can see, even the previous two topics attracted quite a few hands, quite a few questions, but just stay put. We're not ignoring you. We're just making sure we cover all topics, and these are very heavy topics, right? So just bear with us and keep throwing your questions in the Q&A section. We are listening to you actually. The next big topic is the inheritance tax on worldwide assets. Another, I think this is probably another favorite topic as well, Suyesh. So without me saying anything, again,
Yeah.
same question: what it means for us, and what are all these 10, 20 tests, 40%, and the tax tail. So over to you.
Yeah, thank you, Anis. Again, this is another this is another big reason why I'm here tonight, because I think it's just so important for everybody who is listening to understand that from 6th of April 2025, with the new tax regime in place, your overseas assets are now within UK IHT scope. So most of these millionaires and billionaires that have gone away from UK, is one of the biggest reason is this, because they obviously then they don't want to expose their overseas assets to HMRC. And now, with the introduction of this new tax regime and the residence, if you have been in the UK 10 of last 20 years, your assets in India are under UK IHT, or your assets in, for example, anywhere, USA or whichever country. We do have most of our audience is from India, so I'm pointing my examples to India, but yes, we have quite a lot of people, audience members from different countries. So yes, it applies to every country, honestly. So yeah, 10 of 20 years is the timeline. So including me, I am in trouble as well. So what my point is, that obviously we cannot cover all the minute details of IHT planning. But my point here was the awareness, that I want to make sure that you guys think about this and do something about it, not just like don't being not aware about it, basically.
This has been a concern for a lot of us, including myself. Now, if I was to simply ask you, tell me one takeaway, what is that action you would suggest to us? Is it a specialized service or something that you're redirecting people to, or
Yeah, I mean, there are things that you can do. And one of the very important thing I wanted to highlight is, very recently we've been working on a client, and it was very heartbreaking to see that one of the parent did not have a will. If you don't have a will, then your assets, when it comes to IHT, goes to who the government wants. And that is not something you would ever want to have the option as. Please have a will in place. So it clearly says who the assets are going to, and it helps tremendously in your IHT planning. So after reading more about it later on, people think, where am I stuck? And I do hear this quite a lot from people being so frustrated about how the tax has become in the UK. The tail that's mentioned on the slide is because if you move out of UK this year, next year, there is a tail that will follow for IHT purposes. So if you are staying in USA, you decided to now move and live there, and unfortunately you passed away within first year or second year, because you've been here for, like, I don't know, 10 years or so. So then you might have to have certain number of years to live before this goes away. So that's a very important point to understand. So just be aware of how the IHT implications will be for your overseas assets.
oh, brilliant. Suresh, thanks. I think we should take this as an input about having a dedicated session for IHT. But here's the next one, my
Okay, I
favorite
think
one for a
inheritance
lot of
tax.
fun.
Okay.
So the next one, it is a very popular question. You've explained this to me thousands of times, but for your listeners, make it 1,001, right? What is this 100K tax trap? How
This
can
is
one dodge it?
this is a very important topic because of the change. Now that you are going to pay tax on your overseas assets, what is going to really happen is that, if you are, let's say, if you were earning 95,000 pound, and if you have, let's say, 10,000 pound of overseas income, interest, rental, whatever you have, that takes you into the 100K bracket. When you start earning above 100,000, for every £2 you're losing £1 of your personal allowance. So when you go to 125, 140, I just keep it to 125 for
Yeah,
simplicity,
yeah.
all of your personal allowance is gone. What it means is that on that 25,000 pound of tax, you are going to pay 60% tax. And that just disturbs me a lot, because with the way we do tax planning, I have seen people manage to save so much by just doing good tax planning. And in most of our tax planning, we do pension planning for clients a lot. Right now, my calendar is pretty much fully booked up until 27th of March or 28th of March, because all we are doing is pension planning for new and existing clients. Let me give you a little example here, because it's very important to get this very clear, because people know that pension helps and pension will save you tax, but people don't do anything about it. Generally, what they do is they just have salary sacrifice in place, and they think that, oh, my income was 140,000 pound, I've already brought it to 120 or 110, and it's just too much. I can't do anything more. Let the 10,000 go, and I'll pay 60% tax on 10,000. Don't do that. Just put 10,000 also in pension, because you have paid 6,000 pound in tax on that 10,000 pound. Tell me, what would you have achieved by getting that 4,000 in your bank account? And I feel bad about this, because obviously for me it's very difficult to do this planning for so many people, that I'm not able to reply to people that easily. I'm just so busy on my phone as well. So I thought, let's do it this way. I want you guys to really think about it. So if you had that 10,000 pound and you decided just to do nothing about it, and because it's tax deducted at source, you would not realize that how much tax was deducted. But in reality, you lost 6,000 pound in tax for no reason. What you would have achieved with that 4,000 pound? Yes, if you are in dire need of cash, then there is no option, and I would obviously not push you to do that. If you have some emergency, or if you want to buy a house, then you need cash, then forget about this. It's not something you should do it.
This is a great opportunity where instead of giving 15 minutes to every individual or half an hour or more, you're taking this opportunity to educate them. So, for our listeners, there is a free tax health check that Meta Accountants has on its web platform. It's quite good. It's a good starting point. I've tried
Yeah,
this myself as well. I found it useful. Obviously, I had to do a little bit of homework following that, but it was a great starting point.
I know we're running out of time, but I want to give away a little bit more important points here. So, what I'm trying to say is that when you have that 10,000 pound of income that you didn't salary sacrifice or do anything about it, now is the time. Before end of financial year, what you can do is revisit what is your overall income, and if you are somewhere close around 100,000, please think about it. And now that obviously you can't do salary sacrifice, the other option is you can do an SIPP. So you can just go into same pension pot and put a money from your own personal pocket.
When you say SIPP, what does that stand for? Sorry?
Self-invested pension plan. Yeah,
Okay.
simply
Yeah.
means you contribute in your pension from your personal bank account rather than
Okay.
doing a salary sacrifice. I think it's a great option because it gives you the flexibility to stay all the way to 5th of April. I can go on and on this one. Please do your maths well. We also have a tax calculator option on our website as well that you can explore. That is quite interesting.
There's a supporting question now, which is there are people who don't want to invest in pension. I'll put my hand up, and for a long time in your 20s and your early 30s, you don't see pension as a fantastic product, right? Because you don't see the money coming to you.
Lovely question.
Yeah, so in that case, where would you redirect people like me who don't see pension as a great product?
This is a good
Oh,
question. There are other options which I'm not going to go into detail because it's just, again, it will take a lot more time. I want to stick to pension because I don't think there is anything better than pension. When I was in my early 20s, I opted out of pension. And now, after tax planning in so much detail, for example, if you think that, oh, money is getting stashed away and why do I have to put money into pension? What otherwise you would do, Anis? What do you want to do? Tell me any option which can give you this return, 50% return on investment instantly. Forget about this is the instant return. Okay. When you are in the tax trap bracket, when you're in your 45 additional rate tax, you still save 45% tax. So what I'm trying to say is that, okay, you didn't do anything. You took the money out, you took it in your bank account, then you either put it into your interest in bearing account, or you would eventually put it back into stock market. And that's what everybody will do. If you think wisely, then this is extremely important for anybody who is in late 40s or early 50s. That imagine you're going to get hold of this pension very soon in like whatever 5-10 years time. So if you were to invest it outside of pension, you then again taking the chance and then you might have to pay tax. But if you do it this way, then you have a great opportunity that on top of the return on instant investment, the compounding also would help you tremendously in like 10 years time. Then another linked point to this is, especially in this day and age, in current situation when the SIPP could also potentially come under IHT, it's, I know there is this question that a lot of people would have had in their head. So what I'm trying to say is that first, I think it may not happen, and it first, or if even if they go ahead from next year with that option, then I think there would be a big, like a pot that they might disallow. And even if they don't do it, there is an alternative that I think is very relevant for the people I work with. So even if you, for example, you were thinking of, let's say, moving back to your home country. I'll take the example of India here. Because what would happen is that you are sitting on £1 million of pension pot. What if you are planning to go back and retire in India? This could be the most amazing thing that you can actually do, because then you are currently saving full tax, putting into pension, then moving to India, transferring the whole pension through the QROPS setup. And we are currently doing this for so many individuals. A lot of people who are going back to India, and a lot of our existing clients, we are helping them moving their pensions back into India right now through the QROPS way. So what is that? What is really happening? If you move a £1 million pension to India and then you move to India, then you can just withdraw that tax free. That is a great planning if that is what your eventual goal is. But look, there are a lot of things that you need to be aware about. Don't take my words just simply that things are like very easy peasy and all that, but it's all very doable. We are doing this, so think in this direction.
The next topic in our slide was around the ISA strategy and family wealth. You want to spend a couple of minutes on this as to
Yeah,
where
just a
would you
few
redirect
few
people?
There are so many clients I've worked with, and friends and family that I talk to, and they said they do not use ISAs. This is one of the most important thing and the most amazing tool that is offered in the UK to shelter your wealth. Please use ISAs every year for whole of your family if you have the capacity. Again, if you can do it, please use ISAs first, and then of course, if you don't have any option, then you can do whatever way, but utilize your other family members' allowances. And of course, using other family members' allowance is another tax strategy that we can talk about. But
Plus, I think you also mentioned about if you max out your ISA, your partner's ISA, then there's a junior ISA option as well, isn't it? Which
yeah,
obviously
yeah,
comes with
yeah,
a restriction. Yeah,
yeah.
brilliant.
So
I think
junior ISA is also a good option. As I said, yeah, there are so many good
yeah,
options. Yes.
that was so helpful. I just can't stop. What about this and what about that? There are lots of questions flowing. But the person who's been very quiet for the second speaker, and thank you once again for being patient. So for those who joined halfway, Aditya is an NRIs tax specialist and he heads that arm. So Aditya, once again, thank you, welcome, and this is our first webinar, and one of the topics is tax from an NRI's point of view. The first question is, what income is taxable in India for a UK resident? And when should they file an income tax return?
Correct. Yeah. So, Anis, that's a very relevant question, very basic and very primary question to start with. And of course, thanks for your warm introduction. Given the fact that most of our attendees have their roots in India, so yeah, it becomes all the more important to have their Indian tax queries also sorted so that they can have a 360-degree planning as well as understanding for their worldwide income. Anis, so whatever income which is generated from sources within India, okay, so that are taxable in India for a non-resident. So examples of this could be from bank accounts in India, rental income from properties in India, capital gains or dividends arising from shares which are held in India. So all these sources are under the jurisdiction of Indian income tax. Nothing else.
Is there any type of income that you earn in India and you still don't have to do any tax return in India?
There are exemptions for such type of income, but it's no income is fully exempt in India, which is earned through sources in India. Income tax has their hands on each type of income which you can earn. So
Yeah.
you can't be
Okay.
possibly exempt from any type of income fully. And of course, there is agriculture income, I would have said, but NRIs are not allowed to hold an agricultural land in India. So that again is out of the
Yeah.
picture. Coming to the second part
And
of the question, Anis, when should they file an ITR? So basically, when their income exceeds 3 lakhs for an NRI in the new regime of taxation in India. So, and this income does not include capital gain. So, if you have capital gain income source, then, irrespective of the amount, you have to file the ITR in India.
okay, interest on the NRE accounts are not taxed. Is that correct?
So, yeah, interest earned on NRO account would be taxable in India, not NRE account. NRE account comes under UK's jurisdiction. Okay. So, this again, I mean, this extends my answer to the question. If you have a TDS deducted from interest earned on NRO account, then yeah, that makes another reason for you to file your ITR in India.
Okay. Thank you so much. Coming to the next one, which is the most common mistakes NRIs make when they're filing the ITRs and the best way to avoid any litigations from the ITR department.
Correct. That's a very, very, very important question, Anis. Thanks for asking that. And yeah, I have seen in my limited experience of 7 8 years of dealing with NRIs, they make a very common mistake, okay, unknowingly, of course, unknowingly, but that accidentally triggers a lot of penalties in India, which is filing as a resident. So they leave India, okay, they are, working elsewhere, but what they do is you are filing as a resident, you are indirectly giving the income tax a jurisdiction to tax your worldwide income because, that's what the rules are. And so in that case, if you do that, then income tax has the right to tax even your UK salary or your UK pension. So how weird would that be?
When we do tax returns for a lot of our clients, I have seen lot of them are filing as
Yes.
resident. So I think I might have to go away from offering service where we just do filings. Tax planning must be made mandatory because that is when it really adds value. Getting a tax return done on its own is actually, please make sure you're not filing it as resident in India when you file it on your own.
Is it just a tax loss, or are you attracting a penalty as well, or both?
Yeah, you definitely are attracting a penalty. So basically, when you file as a resident and as part of the information sharing arrangement between UK HMRC and Indian income tax as part of common reporting standard, of course. So they know that this person has income elsewhere also in the world, but you are filing as resident. Now, for a resident, worldwide income is taxable. And if you don't offer to tax that income, then of course you are inviting a penalty. So yeah, I think a lot of people have done that, but there is nothing major to worry. You have the option of updating your return, but that comes with a cost, which is penalty for different years. 25, for example, 25% in the first year, 50% in the second year. This penalty is when you offer for updation from your own side. If the income tax reaches out to you, this penalty could be as high as 100%.
What do you mean by penalty? Like penalty on what? Because if you
Penalty paid tax on the unpaid
no,
tax.
because okay, so if I filed as resident my tax return, and because of that you have underpaid tax because you claimed some unnecessary reliefs as a resident while
Correct.
you are actually a
Correct.
non-resident, right?
I see.
Correct.
Makes sense. So of course I think
So
that
this
that
could
point.
this could be tax evasion.
Unknowingly, it is.
Yeah.
Yeah.
So Aditya,
But nothing to worry. I mean,
yeah.
if anyone comes to know that they have done this, then yeah, they can definitely reach out anytime. Income tax does give you a time to sort all this out and get
Aditya,
away with this with a lower penalty.
Hand on heart, I'm not doing it.
someone is asked, can NRI claim the
No,
rebate?
no. So
This
very
this
relevant question. Thanks for asking. This rebate is not available to NRIs, to put it very simply. And again, if you file as a resident, you are effectively claiming a rebate, and that's wrong. And for all those who want to know about rebate, so if you have heard that Indian income tax exempts you up to suppose 12 lakhs of income from this year onwards. So that's because of rebate. 12 lakhs is not exempt; it's a rebate. That if you have income below 12 lakhs, then nothing is taxable. Now, for NRIs, the limit is not 12 lakhs. It is in the new regime, it is 3 lakhs. In the old regime, it is 4 lakhs. For senior citizens, it is 4 to 5 lakhs. So that's how the limits are. 12 lakhs they are claiming because they are filing as resident. And of course, it is system based. So the system automatically gives them a rebate, but they are not eligible.
There's a good build-up question, Suyesh, which is the next one. What should you do as soon as you leave India from an income tax and FEMA perspective? So I think it'll be good, Aditya, you also explain what FEMA is.
Correct, correct. So what you should do as soon as you leave India, okay, you are becoming a new non-resident. So you have to comply with a lot of income tax laws and FEMA laws, which is Foreign Exchange Management Act. Basically, what that means is for someone who's leaving new, they have to convert their savings account into NRO and open a new NRE account. They can't hold a regular savings account. That's illegal.
That's a very, very, very good point. Okay. Because there are so many, I know, attending this webinar, they just have a local bank account. Please, can you highlight how important it is to not do that?
Absolutely, absolutely, Suresh. So, first I'll come to the implication side of things. So the implications of not opening this account is basically, 5x the penalty which you are holding in your normal savings account, which is absolutely huge. And you don't want that. Okay. You have time within 6 months of moving out of India that you have to convert your savings account into NRO and open a new
Oh,
NRE.
five
Now,
times,
the
five
purpose
the balance.
bank balance, yes, the minimum penalty, which they can, if the penalty is huge, they have the right to ask you for a penalty of 2 lakhs. But yeah, 5 times is what they can go up to.
Okay,
So
okay, yeah.
it all
Then,
depends on case to case.
I have a supporting question here. You mentioned about 6 months timeline. Is that from the time you become an NRI or is that the time from you leave India?
It's from the time when you become an NRI.
Okay.
So, Suyesh, as you mentioned, a lot of people have not converted their accounts, and I'm 100% sure none of them would have got a penalty notice. That's because FEMA laws have been lenient so far. But as part of this AI world and huge information sharing between India and UK, now you see a lot more people getting these notices for penalty and demands. So it becomes very, very important from now onwards to have these things sorted out.
the AI is crazy. Everybody will resonate with the power of AI. And see that happening in HMRC as well. Nudge letters and discovery assessments and compliance checks that are coming in place. It is a high time to just tidy up everything.
Correct. Just a quick information. So NRO account is for parking Indian income and NRE account is for parking overseas income.
This is a nice little end to the entire conversation, which is the reverse, which is people who are looking to move back to India.
Correct.
What would you recommend from a planning point of view?
A very hot topic in current scenario, given the
Yeah.
given the huge
That-
changes just
yeah.
mentioned in his presentation. So yeah, this is more relevant than ever. A lot of people are
Yeah,
planning to move
absolutely.
back to India, and there are a lot of things one can explore in terms of tax planning, in terms of moving their investments to India. So in such a case, what happens is tax planning becomes very important. And this tax planning has to be done before one plans to move back to India, because the year of transition is a very important year, and the 2 years following that are equally important. There are certain tax planning avenues which can make your some part of income not taxable in either of the countries. So that's how important it is.
Yeah,
And
absolutely.
yes, yes. And the best part of moving back to India is that you can transfer your pension pot to India straight away without any tax, without any charge.
Just very quickly explain the process and how long does it take? What are the implications?
So you can transfer as soon as you move back to India, as soon as you become Indian resident. And the transfer process takes anywhere between 1 to 3 months. And you get a lot of advantages when you move your pension to India. So the biggest one of them being there is no tax either on the withdrawal or on the transfer. And then India gives you a capital security. So your pension pot cannot go below the invested value at all in any scenario. In fact, it cannot even go 105% below the invested amount. So if you are moving pension worth of
Oh,
10,000,
this I was not even aware about.
that's only because India welcomes this fund, because obviously a
Yeah,
huge
of
fund
course.
coming to their country.
Yeah, yeah.
So they are welcoming it, and there is no tax on the pension at all under the Income Tax Act, and it is not going to be levied at all.
Is that an indefinite guarantee? Yeah.
It's a guarantee.
And
Yes, it's a guarantee
What?
from the pension provider. From if you happen to move in that pension providers, maximum
Mhm.
of them gives this guarantee.
Okay, and another great point right now is the GBP to INR rate. It's crazy.
Yes, absolutely.
So your pounds are going to turn into, but I mean, of course, you can
Yeah.
always have the INR could increase even in more even in future. But yeah,
Yes, yes.
it's quite.
But you do get better rates of return on investment in India, much better than UK. And again, Suyesh, coming back to your point, coming back to your 100K slide. So if you invest in pension, so there in UK, as you mentioned, you save 50 to 60%. And then when you move back, you bring this funds to India via QROPS, and you earn such great return on investment. So how win-win situation it is, that you have saved already
Yeah.
50, 60%, which is great ROI, then bringing it again to India. So how good a tax planning measure this is, and
Yeah,
this ROI.
this is exactly the point of this webinar. It's not about always making money from the tax planning. Of course, we have to survive, and that's bread and butter. People should be aware of all these points and then
A lot of
take
people
the
don't
right
know about
action.
this.
Someone asking the question about whether they can claim remittance basis. They have not claimed remittance basis previously. Yes, you can go back and amend your previous tax returns for 4 years and maybe more, depending on your personal situation, but it really depends whether you are eligible for remittance basis or not. It's not very straightforward. Again, remittance basis is not very simple like concept just to apply. There are number of years that you can only claim and all that. So you might need to probably book a call, like a consultation call with us, or you can do online research and also try and find out.
what does QROP
Yes.
stand
Oh, okay. Yeah. It stands for Qualified Recognized Overseas Pension Scheme. Now,
for? Okay.
qualified and recognized by HMRC, and of course, overseas pension scheme, meaning where the HMRC has shook hands with. So, only those eligible QROPS funds are to be considered for transferring pension into.
Lots of
Hmm.
people. There's an
Yeah, there is
interesting
so many
question.
interesting questions
Yeah.
coming up.
There's one which is I want to take it one from Ajay, which is withdrawal of pension is taxable in India. You can withdraw 30% as tax free. Do you want to take that one?
Yeah, I'll clarify that one. So 30% is correct. The other part is 70%, which can be withdrawn in case of critical illness. So yeah, both of them are tax free, by the way. That's called commutation of pension, both 30% or 70%, or in case of death, transferring to a nominee is also tax free. So withdrawals are completely tax free only after attaining the retirement age, which is currently 55 for QROP schemes. So you start getting pension income, the monthly pension income. Only that is taxable as per your slab rates. I think I have answered Ajay's question.
It's not very straightforward, purely tax free. That when you move your whole pension fund to India, it's not totally tax free in any case. There could be tax on it. Is that what it
Pension
is?
fund is tax free. Only the pension income arising out of that. Again, that is taxable in the UK as well. So yeah, it's the same thing.
I'm going to throw a spanner in this plan, right, Aditya? In this day and age where the governments are actually after our money, and you've so openly talked about QROPS, which is like, oh yeah, click of a button, go there, and job done, right? What's the catch here?
Correct.
Like, what can make your suggestion not work for you? For example, I want to come back to the
Yes.
UK. What does that mean? Did I just lose? What will be the impact of
So
back
there
to
is
the UK?
yeah, that's right. One catch which is there is that obviously the UK won't like money going out of their country. So what they have made a rule is that once you transfer your pension to any country, then in the next 5 years, if you become a UK resident, then they levy a penalty of 25%.
Okay.
Okay.
Yeah, and from India's side, there is no catch because, of course, as I mentioned, India would welcome a huge chunk of fund coming in their country from abroad.
Okay.
This 25% tax charge comes in place, Aditya?
So when someone leaves the country, okay, and then they become a UK resident again in the next 5 years.
That's the anti-avoidance rule. I mean, there are so many points we can discuss, but this is the exact thing. So, for example, people who have moved to Dubai, and I have clients right now talking to me, thinking about coming back into the UK. Imagine someone who went to Dubai, sold off his portfolio of, stocks and funds, thinking that obviously he didn't have to pay tax in Dubai. Now coming back to UK is not an option. I mean, of course, there is an option, but you are exposing yourself to paying the tax on that
Exactly.
the disposal that you did, and you did not pay tax because you were non-resident, and you are coming back within the
Exactly.
5 years. So this is the biggest
Exactly.
problem we are facing right now, with lots of clients reaching out to us as well. This is a very good point in general I wanted to touch, that when you
Absolutely.
plan to move out of UK, you need to think always in long term of at least 5 years, because otherwise
Yeah.
all of your tax planning will actually go in vain. So please make sure, again, you do these things very, very carefully.
Exactly. One needs to
and
plan very well in order to move bases from one
Yeah,
country to
and
another.
and in fact, always always do tax planning from both sides. So when you're going out of a
Absolutely.
country, you need to do tax planning, and when you're going into a country, you need to do tax plan. Please, please don't think of that you're spending money. Please don't think it that way. I'm telling you with my experience that I have saved so much for like in taxes for people because of tax planning. It's just that people don't do it thinking, oh, why would I have to pay someone with just basic things? I know about pension. Yeah, everybody knew about pension who came to me doing tax planning, and yet ended up being so surprised and then saying, oh, thank God we did it. So my point, this is the point of this webinar, to make you aware. Don't do this, please. Do take professional help, and do take just not tax, take professional help everywhere. Just go with the highly recommended professionals, probably, who know what they are doing, because they will save way more than what you're going to pay them in the fees. And just one last point, guys, from my personal experience of how I have helped people, I have started taking professional helps everywhere, because with the same Indian mindset, I would not pay, right? We just don't pay. We just don't want to pay.
are you saying a doctor going to a doctor? Is it?
And doctor is something else. Doctors are
Yeah.
God. You always go there to.
Here's a question I have for both of you. Start till the beginning. You through options invest, IHT, bank account, this, that. and I'm now leaving the UK. So talk to me on the reverse, right? What happens to my ISAs? What happens to any of the inheritance plans? And let's try and summarize it for us in a few words.
So, Anis, yeah, that's a very relevant question. We have talked about pension, but what about the bank accounts and the ISAs in the UK? So, I'll first talk about the ISA lose their tax free status when you move to India. Of course, India doesn't recognize ISA or anything similar to that. So, whatever interest you are earning out of your ISAs in the UK after becoming Indian resident would be taxable in India. Okay. Then, what happens to UK bank accounts? Again, I mean, if you are earning any interest from UK bank accounts or dividends from your investments or capital gains from your.
I'll be a bit specific here because you mentioned
Yeah.
about when you leave India, declare yourself as an NRE and get an NRO account, NRI, get the NREs and the. Do we need to do something similar in the UK?
Suyesh, I would definitely bug you for this. You would have to you will have to answer this.
Oh, it doesn't matter. Maybe there is nothing to be done.
So even in India, this is as part of the FEMA compliances, not as per the income tax compliance.
There's one specific statement that was mentioned, which is mind the gap, which is UK India tax residency test. Do you want to just throw some light on this one?
Yeah, a very important technical yet something to consider well in advance. Basically, both the countries have their own set of rules for residency test. Okay. So, once you move back to India or plan to move back to India, you might become an Indian resident as per Indian set of rules. And at the same time, you might also end up becoming a UK resident as per the UK, statutory residency tests. So in that case, Anis, what happens is you become resident in both the countries. Now, both the countries would want a share in your income. Of course, which government wouldn't want a tax? So in that case, there are tiebreaker rules in the double taxation avoidance agreement, which can be referred to. And based on that, we have to document the tie breaking rules and tie break the residency. So this gap has to be bridged. This gap of residency. So for a taxpayer, the relevance is that wherever he is becoming resident, ultimately, as per the tiebreaker rules, that country will have the right to tax his worldwide income.
What I wanted to add on this is that it is just coming to the same point that going out or coming in, you just need to do tax planning very well. I mean, we do this for a lot of people. So we prepare reports when people are going to move out of UK, and we give them the whole planning strategy on how, when, what if things. Please don't be in the mindset of not taking professional help. Please don't do that. It's not for me to make more money. You don't need to use Meta accountants for your services. You go and use whoever you want to, but take professional help. It will help you. Trust me.
This is my key takeaway as well, that the professional help just pays off. It just pays off, either right away or over a period of time. In the interest of time, Suyesh, fantastic questions. I think a lot of people, we managed to hold them back, which itself means that, we've added some value. Thank you so much. It's quite late in the day. Before you shoot off to bed or for a lovely dinner, if you think this was useful, please leave us a review.
I'm so overwhelmed with such a lovely feedback already that people have shared, and I'm so thankful that everybody enjoyed this session. And that was the whole point of doing this webinar. And if you need professional support in your tax matters, then of course you can also reach out to us.
Thank you. All the best. Good night.